Welcome to Shortview Trading. This is your morning market update for Tuesday the 24th of March on London's first day of full lockdown. What matters today for traders? Well, price action on Monday was choppy and disappointing in US markets as participants worried about whether or not progress would be made on the fiscal package. Encouragingly, though, there was an awful lot of new Fed programs coming out. Not only did that include aggressive daily buying of treasuries and mortgage-backed securities, but it included also a primary and secondary corporate credit market facility. The primary facility offering credit lines to investment grade companies, the secondary where the Fed is buying the corporate debt, investment grade corporate debt in the market. All of that is helpful in terms of addressing the dysfunctionality of markets and the widening of credit spreads, particularly in the investment grade arena. And also encouragingly, after the US session, it looked as though the policy on the fiscal side was drawing to a rapid head and a conclusion. And also encouragingly on the fiscal policy side, Mnuchin and Chuck Schumer, after the US market closed, looked as though they were getting close to a deal. Overnight, the market's been encouraged by that. Asian price action's been good. More interestingly, there are growing signs that the credit crunch is beginning, and I emphasize beginning, to ease. That's most obvious in the price action of gold and TIPS yields. As you can see in the chart in front of you now, TIPS yields backed up hard until a few days ago, and gold was hard hit until a few days ago. Since then, gold has rallied, TIPS yields have come off. That reflects the dollar swap lines and the opening of more aggressive international dollar liquidity availability by the Fed. That was announced at the back end of last week, and the move to daily funding operations in international dollar liquidity started yesterday, Monday. All of that has helped push gold up and ease the pressure on TIPS, with those TIP yields coming off sharply. That's one of the first signs of the easing strains in the dollar funding market. That's encouraging, and the dollar is weak on the back of that. Having said that, there are still plenty of signs of tightness in global financial markets. In front of you now, we're showing you Eurozone and US high-yield corporate bond spreads. These made new wide levels yesterday. So some of the credit markets are still proving challenging, but the point is the thaw is beginning. That, coupled with the progress in the fiscal discussions, as well as the positioning of our models, which remain very attractively on strong buy, adds to the sense that we could well be base building. Now, whilst the S&P's been making lower lows and lower highs recently, it's important to note that the speed of descent is slowing, and in some indices, the base building is more encouraging. The Nasdaq, for example, as I'm showing you now, is broadly unchanged in the last week. For full details on how we're approaching these markets, please see today's Daily Rag, available to subscribers and on the website. So what are we watching today? Well, we'll continue to watch the credit markets closely. They're key. Dollar funding issues are key. Credit markets and how they behave is critical. We'll also be watching for anything policymakers announce, and in that respect, particularly watching the continued progress, hopefully, of the US fiscal package. And then over and above that, flash PMIs are going to be interesting as they come out this morning in London time. They should give us some initial insight into March's economic activity. So that's it from us. That's your morning market hit for Tuesday the 24th of March. Please do subscribe on LinkedIn, Twitter, YouTube, and/or Facebook. Thank you very much for listening. Stay safe.